So in Chapter 8, we study the firms in competitive markets. And first, let's look at the profit maximization decision by the competitive firms. Because the firm is in perfect competition, it faces a flat or horizontal demand curve. If the firm raises the price above this market price, right, all the customers go to another firm. So that's why a single firm in a perfectly competitive market faces a horizontal demand curve, and the firm is a price taker. Right? For every unit, it can only sell at the market price, cannot sell for more. Right? The firm always would like to sell for more, but whatever the market price is, that's what the firm will get. And this picture is the particular situation for a firm in perfectly competitive market that trying to maximize its profit. We have seen a similar picture before. In that one, the marginal revenue curve is not necessarily a straight line. Here, because it is a perfectly competitive market, the demand curve is a straight line or horizontal line for this single firm in the competitive market. And this horizontal demand line is the marginal revenue curve. Compared to the marginal cost curve, right? The marginal cost curve is rising. So the difference between the marginal revenue and the marginal cost curve is the marginal profit. And at point E here, the marginal profit is 0, right? Before point E, or say the quantity is below 284, the marginal profit is positive. It's still the difference between the blue line and the red line. Blue is the marginal revenue, red line is the marginal cost, right? If the firm produces beyond 284, the marginal profit is negative because the marginal cost exceeds the marginal revenue. Okay, this negative marginal profit will lead to the decline in total profit. Okay, in this portion. So the firm can maximize its profit by producing 284 units. Selling 284 units into the market, the profit is maximized. That's where its marginal cost equal to the market price. We need to know that the picture on the top and the picture in the bottom have very different meaning. The picture at the bottom has total profit on the vertical axis, right? Both pictures have the quantity produced or quantity sold in the market on the horizontal axis, but for the picture on the bottom, it's the total profit. But for the panel A, right, this picture on top, all the curves are for each unit. For this price, it's each unit sold at this price. For the average cost curve, this is the average total cost. It is for every quantity. It shows us the per unit cost on average. Okay, for every quantity, there's a different average total cost. This marginal cost curve shows the marginal cost for each unit that is produced. So for each unit, it's different. Right? The marginal cost curve is really talking about a specific unit that is being produced. Right? What's its cost? The average total cost is the same average cost for every unit that is produced. So, in this picture, what we can see if the firm produces 284 units is that each unit sells for $8 and the average cost is $6.50. So the profit margin for each unit sold is 8 minus 6.5 is $1.50. So $1.50 times 284 units. Here the units is actually 1,000 metric tons of lime per year. We know that the profit is $1.50 times 284,000. We have $426,000. So we have seen that if the market price, this flat line, lies above the average cost curve in this range, the firm will produce at a quantity where the price meet the marginal cost. And if the price is higher, the firm will produce a higher quantity. If the price is lower, the firm will produce a lower quantity at this point. And at this quantity where the price meets the marginal cost, the profit is maximized. As long as the price falls above the average cost curve for the quantity produced, right? Let's see. For this quantity, right, this price is above the average cost curve at this point. As long as that is the case, the firm make profit per unit product sold, and there's a total profit. However, it can be the case that the price is between, right, the lowest point of average variable cost and the average total cost, between point A and point B. That means for the profit maximizing output level, right, for a point like this, or this point E here, it is maximizing the profit, producing 100 units, but the price is below the average cost, or say the average total cost. It means the firm is making a loss. So again, for price level between A and B, the firm is losing money. The question is whether the firm will keep producing at this level. Remember that we are talking about the short run. In the short run, we assume that the fixed cost is sunk. So if the price is between the minimum point of average total cost and the minimum point of average variable cost, even though the firm is making a loss per unit sold, the firm still can recover some of the fixed cost that is sunk by operating. By keep producing, the firm actually make a margin above the average variable cost curve, the purple line here. Right? At the quantity of 100, the average variable cost is $5.14. The price it can sell its product is $5.50. So there is a 36-cent margin per unit sold. And this margin can help the firm to recover some of the sunk fixed cost. On the book, the firm make a loss, which is the area A. It's the average cost, $6.12 minus the $5.50. The per unit loss on the book is 62 cents. The 62 cents times this 100,000 metric tons, right, this quantity produced, we have the loss is $62,000. But what if the firm shuts down, right? If the firm shuts down, what we know is actually the total fixed cost is A plus B. that will be $98,000. Okay, that's the $98,000. Remember that the distance between the average cost curve and the average variable cost curve is the average fixed cost. Here at 100 units produced, the average cost is $6.12, and the average variable cost is $5.14. So the average fixed cost is 98 cents. 98 cents times 100,000 metric tons, we get $98,000. That is the fixed cost for the production in the short run. Compared to $98,000 loss, this $62,000 loss, just the area of A, is smaller. So even though the firm lose $62,000 when producing 100 metric tons, the firm make a smaller loss compared to completely shuts down. And that's why when the market price, the firm is a price taker, this market price is what the firm gets for its product. It has to take it. Right? When this price is between point A and point B, or between the lowest point of average cost and the average variable cost, the firm keep operating. Even though it incurs a loss, the loss is not as big as the complete loss of the fixed cost, which is assumed to be sunk in the short run. And then when the price falls below point A, the firm cannot even recover the average variable cost per unit by selling a price that is below $5. The firm will stop operating. Because if, say, the price is $4, it basically handing out $1 for every unit it's put onto the market. It doesn't make sense. And that $1 put on per unit will be on top of the sunk $98,000 fixed cost loss. So that's why if the firm face a price that is below point A, the $5 mark, the lowest point of average variable cost, it will shut down. But as long as the market price is above point A, the firm will keep operating. Even though it may face a loss when the price is below the lowest point of average cost curve, point B. And again, if the price is above the lowest point of average cost curve, above point B, or say $6, right? If the market price is above $6, then the firm can make a profit. So above point A, the firm will keep operating, and above point B, the firm can make a profit. But below point A, the firm will shut down. Now that we have seen the profit maximization decision and the shutdown decision by the firm, we are ready to look at the short-run supply curve by the firm at different demands. Again, the demand faced by the firm is still these horizontal lines, because the firm is a price taker in the market. The market gives the firm a price, the firm takes it, and at a different price level, the firm makes different decisions. For prices above $5, the firm offers according to its marginal cost curve. Right? That's the profit maximization decision. If the price falls below $5, the lowest point of the average variable cost curve for this firm, then the firm shuts down, provide nothing to the market. As long as the price is $5, the firm at least produce 50. If the price going up, it will produce at the quantity where the price meet the marginal cost curve. So in the short run, the competitive firm's short-run supply curve is its marginal cost curve above its minimum average variable cost. Once we have derived the short-run supply curve by a single firm in a competitive market, we can assume the simplest situation that every firm in the market is identical to one another. Then we can derive this market supply curve. Here we just, again, add the quantity supplied horizontally at different prices. And for each firm, we add the quantity supplied up. And eventually we have 5 firms in the market. Showing in the picture here, we have this S5 as the market supply. That's the market supply curve when we assume the simplest situation that every firm are the same. Every firm has the same short-run cost structure. It's also possible that the firms are different. In this picture, firm 1 with S1 here produce 50 units if the price is 5, at least 5. Below 5, firm 1 produce nothing. But firm 2 has a higher cutoff for shutdown. That means if the price is $6, firm 2 produce 25 units. If the price is below $6, firm 2 produce nothing. So, given this short-run supply curve by the second firm, once the price is $6, the second firm will put additional 25 units into the market, and then it will keep adding output if the price goes up according to its marginal cost curve. So after $6 price, for the prices above $6, we can again sum up the quantity supplied by the 2 firms to reach this market supply curve. So you see, when the costs are different between the 2 firms or between different firms, we will have sections there might be a flat portion in the market supply curve. Now let's look at the short-run competitive equilibrium. Panel A shows us the single firm's cost structure, the marginal cost, or say the short-run supply curve by the firm, the average cost, and the average variable cost. And panel B on the right shows us the market supply. Here we still assume there are 5 identical firms. They all have the same cost structure. This market supply curve can intersect with different demand curves, either D1 or D2. So let's look at D1 first. This is a relatively high demand, and given this D1 demand and the market supply curve, we have a market price of $7 per unit. At $7, one firm will produce 215 units. And there are 5 firms, so the total market output is 1,075 units. For each firm, we are looking at the price is $7 per unit. The average cost is $6.20. So each firm per unit margin is 80 cents. 80 cents times this 215 units. Each unit is 1,000 metric tons. One firm making $172,000 in profit. That is in the short run. This is a short run profit if the market price is $7. Now let's look at the second demand. This is a lower demand, and it intersects with the market supply curve at $5. So the market price is $5. And this is barely make the identical firms simply break even on variable cost, not the total cost. So the firms actually make a loss. Before we examine the loss, let's look at the output decision. Each firm produces 50 units. 5 firms produce 250 units. The loss is average cost $6.97 minus the price $5. So each unit, the loss is $1.97. And the firm produced 50 units. The 50 units times the $1.97 loss means that each firm loses $98,500. Remember, even though in the short run this is a loss for every firm, they do not shut down because the fixed cost is sunk. They can cover its out-of-pocket expenses, the variable cost, by selling at $5. This is the short-run competitive equilibrium. 2 different demand levels, 2 different price levels. So in the short run, the firm can face a short-term profit or a short-term loss.